So the UK mortgage time bomb is here, and it's left homeowners walking a dangerous knife's edge with much higher monthly repayments. In this video, I want to cover the harsh reality of what these payments actually mean, but also offer some potential options for those who are affected the most. I also want to offer some advice to the younger people who are not yet on the property ladder, who find themselves in a very strange situation, asking that old Shakespearean question: to buy or not to buy? When it comes to UK property right now, is it smarter to play this waiting game, hoping for a crash, or is it indeed better to jump headfirst into the shark-infested waters of higher interest rates? Many of you watching this video will already have fixed-rate mortgages that may be due to renew in the coming months and years, while others watching may just be looking to buy your first home. Whichever you are, one thing is for sure: you should be very concerned about the impact of these rising rates. So first, let's address the easiest question to answer for new buyers. Should you wait for a property dip? Analysts and so-called experts are expecting a property crash in the coming years to range anywhere from a slight 2 to 3% stumble all the way to a head-spinning 35% plunge. The difference in this so-called analysis is absolutely staggering. It's kind of like comparing a hiccup to catching your nutsack in a zipper. But nonetheless, the data is showing that home sellers are starting to knock off a little from their current asking price, which is a start, but it's very far from a full-out 35% crash. And on that, for the new buyers, historically speaking, when property prices do crash a lot, it's usually those who are already financially secure who reap the best discounts. So I think the whole wait for a dip approach could actually just leave you waiting too long and eventually miss out on a good deal completely. So it might actually just be best for new buyers to consider taking the plunge, albeit an expensive one. As mortgage rates try to do their best Mount Everest impression, the odds are looking more and more stacked against those looking to get their dream home first time. Zoopla's previous data showed that these rising interest rates from 4 to 5% could knock off about 11% of an individual's buying power. They also said in this article that if it swells to 6%, then say goodbye to a whopping 20% of your purchasing power. Basically meaning you can now afford much less house than you could have afforded a couple of years ago. And this of course applies to not only new buyers, but also those who have fixed rate mortgages. Yes, those who already live in a home they have a mortgage on. I want to explain things simpler on this Excel, which I did steal from the Honest Money channel, so big shout out to them. Now, the average house price in the UK is apparently around about £286,489. Now, according to Bankrate, the average deposit on a UK mortgage is around about 15%, meaning the average home mortgage after the deposit will be somewhere around about £243,000 on a 25-year plan. Meaning, if you were wise enough to lock in a 2% fixed-year monthly mortgage, you'd be paying somewhere around about £1,032. If the numbers are overwhelming you, don't worry, I'll simplify it in a minute. But when this fixed rate expires, the new rates are not as friendly. As rates hit 6% and maybe even go all the way to 7% in the future, you can see that people's buying power is drastically affected. That £1,032 fixed rate monthly mortgage will have increased by 52% on a 6% mortgage rate. Simple terms, you used to pay £1,032, you're now paying £1,569, and if it goes up to 7%, it would be a 67% increase on your monthly repayments. Imagine trying to find an extra £700 a month just to keep the house you currently live in. Not getting any benefits, just the same house, just more expensive. And it gets worse, because according to economists and these previous mentioned analysts, rates are probably going to stay high for the coming years. A Bloomberg report estimates that mortgage rates will probably stay near 5% up until at least 2028. And if people cannot afford these price increases and constant paying, they lose their savings to offset this bill, well, they're going to be forced to either sell their house, downsize, or quite frankly just lose the house altogether, which ultimately adds more sellers into the market. And according to the Telegraph, 2 out of 5 homeowners are now selling at a discount, which is confirming there's a short-term oversupply. But it is a catch-22 oversupply because buyers cannot afford the same amount of house they previously could in this high interest environment, meaning they are buying less. It's a complete mismatch right now between supply and demand, and it's gonna get worse, which also confirms that a potential crash could happen. It seems like the market is playing tough with both buyers and sellers. So it's important more than ever that you do indeed protect yourself. So what can you do if you currently have a fixed rate and the term is up very soon? Well, to be honest, it depends on your mortgage provider, and some of them may offer some options. There's things like pauses on your mortgage. You could even switch to an interest rate only mortgage for some period, and some even offer a 12-month deference on any defaults. But really, it just depends on your provider and also on your individual circumstance. But it is going to get worse before it gets better. For those of you who are on the property ladder, even if you're not struggling right now, I suggest you contact your mortgage provider ASAP and look into options that you may actually need in the future. I would also highly recommend you formulate some form of budget to tackle if rates do go higher than the current estimations. After all, we're way over the estimations from last year. And for those of you who are in that group looking to get your first home right now, I'm afraid it's not any better news. Rates look like they're gonna stay high in the coming years, and if the market does indeed crash, the bank could step in and lower rates, meaning that prices will come lower again, and then buyers who have a lot more buying power will come back in and push the market back up. Basically, it could be near enough impossible to time when exactly to get in on a dip, especially given there's a huge undersupply, geographically speaking, across the whole of the United Kingdom. The reality is, if you're a new buyer, it might just make sense getting your foot in the door on a property itself. These current terms of high interest rates are the current environment. It's something you need to adapt to. If you can wait 5 years or so renting out a property, then things might get better. But this could also be the new norm. But if it was me looking at buying my first house and starting a family and all the other jazz that comes with it, I'd probably just look at buying a smaller, cheaper house than I intended to initially. I'd then in a couple of years look at upsizing when I've got equity built up in that house and things look a little bit clearer, or hopefully more like they did 10 years ago. These next 5 years are going to be extremely tough for anybody owning property in the UK. And even more so when you actually look at the harsh reality of what is coming with inflation, which I talk about in this video here. It's going to be an extremely tough couple of years for anybody with a mortgage. So make sure you do budget correctly, and I wish you the best of luck.